now we're going to have Eben Mare. Can we save from University of Pretoria. He's going to talk about can we save the recovery theorem.
Thank you. First of all, thanks to the organizers. It's beautiful. It's an honor to be here. And Pretoria is almost as beautiful as Búzios, but thanks for the opportunity. So I suppose can we save the recovery theorem was a bit of a pre-conference hyped talk or title. It's really can we use the recovery theorem. So Steve Ross published a paper in 2015 talking about conditions where we can actually recover real-world data from option prices. Now, we've spent many years throwing away real-world data to get to the risk-neutral part. Can we actually get back? Given the time of the day, I thought the optimal strategy is here to show a couple of examples and a couple of pictures. What I'm going to do here is I was suffering from a bit of home bias. So I'm going to give you the FTSE JSE Top 40 Index. This is the tradable derivative index on the Johannesburg Stock Exchange, where options and futures trade very freely. And I'm going to show you the dollar rand, which is an example of one of the interesting, the dollar rand punches way above its weight in emerging markets. And I'll show you an example of that in a second. It's very liquid, and I'll show you some examples of what the recovery comes out of that. So what I'm going to do is I'm going to show you some vol surfaces. From those, I'm going to go to the risk-neutral distribution, show transition probabilities, the risk-neutral transition probabilities, then go into 3-month real-world distributions. I'll show that for both. I'll show a trading strategy, because what is very important is what does the data mean that we get? I think it's very important to see if it's really something meaningful. As an example, if we look at the data that we get out of variance swaps, there's a number of studies that shown that the data has predicting power. Do we get anything more out of this? So it's that type of thing, and I don't have those answers yet. So I'll talk a bit about the method and some implementation issues. I think what's very important to understand here is some of the news or some of the press that you've had the recovery theorem get is it's tough to implement. It's tough to implement because you're basically solving two ill-posed problems. And I'll get to that in a second. So first, arbitrary example, 14th of August, here is the top 40 volatility surface. Nothing special about the date. I'll get to in a second when we talk about the dollar rand, how we've constructed that. From the top 40 volatility surface, we construct the risk-neutral distribution. Nothing funny about this. This is Breeden-Litzenberger. From that, we actually construct the risk-neutral transition probability matrix. And for that specific date here, you've got your risk-neutral distribution in, the risk-neutral distribution, and the blue line shows you your real-world distribution. Great. And in the next slide, what I've done here is we've got data here spanning a period of about 10 years. And beautiful, here is the real-world evolution of the top 40 3-month real-world implied distribution. Nice. I mean, the numbers are intuitive. You can actually see here the skew structure. And if you look at this as the 5th percentile, so this is basically the number that we get out of here is your value at risk over a 3-month period. The numbers that we've tested this far show us that this number outperforms historical simulation. So it's nice. This is something that you would expect that your recovery theorem should give you. So, but the testing is still in construction, I have to say. So the author Bukowski said that some moments are nice, some are nicer, and some are even worth writing about. So let's look at the moments. So here's the mean. Blue line shows you the 3-month implied recovered mean. and the black line is basically the risk neutral mean. What's very interesting about the blue line here is these are basically the ex-ante numbers. They do correspond, interestingly enough, to the ex-post 10-year real-world observed returns. In the background, I've just shown the total return of the index over that period. Similar thing for your real world versus risk neutral volatility. And then I've also just shown here what your real world skew versus your risk neutral skew looks like. And we'll use this in a second. And here's your kurtosis. So those look fairly similar, but there are a couple of changes. I get great delight drawing out these numbers. I mean, if you look at the distributions and stuff, they're interesting pictures, and there is some information in here. The question is actually how much. And Darrell Huff said that if you torture the data for long enough, it will confess to anything. So the question that I've got here is, how do we test things? Oh, sorry about that. I understand. Sorry about that. So what we've done here is we've done a very simple, naive trading strategy. What we've done is we've got these moments, and what we do is we say, from a tactical asset allocation perspective, let's assume I'm an investor who wants to be long of the index. All I'm going to do is, if my current return, skewness or kurtosis, is higher than you had in the previous week, I'm going to hold the index. If it's not, I'm going to actually just go into cash. And we do the reverse, where we actually just have, if volatility is lower, I'm going to hold the index, and otherwise not. Very simple, similar to a volatility timing strategy. Okay? So just to see if there's information. So the numbers that we get here show the following. From the top, this is just holding the top 40. The mean is about 16%, and the volatility of that is about 21%. If I look at the risk neutral moments strategy, if I just look at volatility, I underperform just holding the stock. But what is interesting is if I look at the maximum drawdown, my risk-adjusted number looks much better. So I get a number that outperforms the index because I've got a lower drawdown. Very interestingly, if I look at the risk-neutral skew, I get a number that gives me alpha. So I outperform the mean, just holding the index. And on a Sharpe ratio basis, you can see even risk-neutral gives me some information. Again, nice drawdown characteristic. If I look at the real world moments, the mean outperforms just holding the index at much lower volatility and much lower drawdown. Interesting Sharpe ratio as well. Volatility derived from the real world, similar story. Interestingly enough, underperforms drawdown here, and you can see skewness gives you a very nice Sharpe ratio. What's interesting from these numbers is that both your risk neutral number as well as your real world number gives you information, number one. Number two, your real world seems to outperform risk neutral, which is interesting as well. So just for interest's sake, if you look at the dollar rand, if you look at the daily forex turnover as a percentage of annual GDP, South Africa trades amongst the highest in the world, which is very interesting. So the South African rand is very liquid, and it's very frequently used as a proxy for emerging market woes. So we get punished if you have any emerging market turmoil. So let's talk about recovery. How does this work? So recovery is a process. You basically start off with your prices. You construct a state price matrix. You construct from that a risk-neutral transition price matrix. You apply the recovery theorem, And so your first ill-posed problem here is basically going from the data to your risk-neutral distribution. So the way that we look at that is here is the vol surface for the dollar rand. In the South African market, most markets are over the counter, and they're largely driven by brokers. So what happens is you get fairly good quotes for structures, typically butterflies, risk reversals, put spreads funded by call overwriting. So we use the stochastic volatility inspired model to give us the vol surface, and from that we construct then the risk neutral distribution. So this piece is simple. Now remember, this is an ill-posed problem. If you make any mistakes here, it's going to be amplified taking into your problem further. The tricky part now is when it comes to the transition probability matrix. One of the assumptions in the transition probability matrix is that it's time homogeneous and irreducible. So basically what happens here is you facilitate it by solving for the transition probability matrix by using the state price matrix. Now this is where a lot of the time comes in. This is where a lot of people use many different techniques for regularizing the problem. Yeah, Jim, please.
I mean, what's your philosophy on this thing? I mean, we can't believe the time homogeneity assumption, right?
No.
So it's giving you some information, you don't know why, but this information is useful. That's the philosophy.
Yes. So it's, we want to do something. We want to get something out. So if you actually think about it in a naive way, if you assume that your underlying is log normal, then your implied vol is actually your recovered parameter. So here we're basically assuming under that structure we get something out. So, and what I'm trying to show here is I agree with you. I think that assumption that it's time homogeneous and irreducible is probably flawed. It's been relaxed by some recent research, but I think there's going to be a lot more work done on that. But I do think that there's some information that comes out that appears to be useful. Yeah. So as you can see here for the dollar rand is the transition probability matrix. Interesting distribution that comes out, real world distribution that comes out. You can see very interestingly in this period under observation, the rand has collapsed significantly. And you can see here that basically to the right, you get a skew instead of, as in the equity market, to the left. Interesting here, now the black line again is the risk neutral expected mean. The blue line here is the market implied mean. And interestingly here, so the results that we get out from, again, the naive trading strategy comes out interesting. So over that period, dollar rand has, as I said, weakened significantly. So the optimal strategy here was just to hold dollars. If you actually look at the risk neutral strategy, your mean would only have been about 10%. Fairly good Sharpe ratio, but not as good as if you just hold the dollar rand. The real world moments, though, give you something that's very close to the mean at a proper Sharpe ratio. So this is interesting. So there is some information. The question is, what do you do with that?
So the risk neutral strategy, what was it?
So the risk neutral strategy here is just based on volatility. And yeah. Sorry, I didn't show the others. I thought it's going to be good. Absolutely. So guys, thanks for the time. So in essence here, we're solving an ill-posed problem. I'd never feel very comfortable with that because you think that, as Jim said, you actually have to impose some structure on here to get solutions out. And if you actually impose enough structure, well, are you actually contriving some solutions? That is the question. So you are dependent on regularization and what is the algorithm that you use. I do think there's a lot of testing required. It's clear from what I've shown here, you get some more information out than in the risk-neutral world. So as Thurber said, it's better to know some of the questions than all of the answers. Thank you.
Questions?
It's definitely true that South Africa is used as a risk for emerging market, but also because the big company in the index is Naspers, is Tencent. Actually, the South African assets are valued, I just checked, minus $30 billion. So there is a reason also because it's in London time trading. So if you want to take a put on China tech, I can trade Naspers. So the arbitrage in Naspers and Tencent is very liquid, and sometimes is the main driver to explain your index, because the other companies are not super interesting for other people outside. Absolutely. I just want to give that.
Does anyone have a question? No, I have a question, but okay. Okay, so you use the SVI approximation. Have you tried the other approximations? Because in principle, you can do lots of different approach there. In particular, try even to go through the local volatility surface. And
Thanks for that question. So in the market here, it seems that the SVI fits very well and works well. So that seems to have been specifically in the equity market. A lot of participants use that, and it's worked well. We have used some other parameterizations, Heston, for example. So, but we seem to prefer this one.
okay, thank you. Nothing against SVI, Jim. Just asking.
We just pray that your market doesn't become
Too liquid.
SBI is worth anymore.
Okay, so let's thank Eben again.
Thank you.